If I told you that silver is headed for $300 an ounce, would you call it madness or a missed mathematical gold mine? Michael Oliver, a legendary momentum analyst, just dropped a prediction that has sent shockwaves through Wall Street. To most, $300 sounds like a fever dream, an impossible 600% surge from today's prices. But here's the thing. Market crashes don't care about your feelings, and hyperinflation doesn't follow a script. Today, we aren't just listening to another bold prediction. We are going to put it to the ultimate test. We're using cold, hard mathematics to verify if this is a financial fantasy or the inevitable endgame of a collapsing system. Look at the S&P 500. Look at the bond market. The pillars of traditional wealth are shaking. Experts are warning of a 50% wipeout in stocks, and as the everything bubble nears its breaking point, smart money is quietly shifting. But why silver? Why now? And why that specific staggering $300 mark? In this video, we are peeling back the curtain on the secular rotation. We're going to decode the gold-to-silver ratio, a mathematical lever that has signaled every major wealth transfer in the last century. By the end of this analysis, you won't just see a price tag, you'll see the clock ticking on the global financial system. Let's dive into the math of the ultimate insurance policy. Because in a world of paper lies, numbers are the only thing that stay honest. To understand why $300 isn't some wild science fiction number, we need to look at a metric that quiet billionaires monitor with obsession: the gold-to-silver ratio. Think of this ratio as a financial rubber band. It tells us how many ounces of silver it takes to buy just one single ounce of gold. Right now, as you're watching this, that rubber band is stretched to its absolute limit. Historically, for thousands of years, this ratio lived near 15-to-1. Why? Because that's roughly how they come out of the ground. For every ounce of gold mined, there are about 15 ounces of silver. It was nature's own pricing model. But look at the screen now. Today, the ratio is hovering around 80-to-1. Sometimes it even touches 90. That is a massive mathematical anomaly. It means silver is being priced as if it's 5 or 6 times more abundant than it actually is, or gold is being priced as if it's far rarer. This is what we call a valuation gap, and in the world of macroeconomics, gaps always, and I mean always, close. Now, let's do some billionaire math. If gold stays exactly where it is today, let's call it $2,500, and the ratio simply returns to its modern historical average of 30-to-1, silver would instantly jump to over $80. That's nearly a triple from current prices just by returning to normal. But Michael Oliver isn't talking about normal. He's talking about a secular rotation, a once-in-a-lifetime shift where the rubber band doesn't just snap back, it flies to the other side. In the great bull market of 1980, the ratio didn't stop at 30. It plummeted all the way down to 17-to-1. In 2011, it crashed down to 30-to-1 again. Now imagine the perfect storm kickbon. Imagine gold climbs to $5,000, a price many analysts see as inevitable if the debt crisis continues. If gold hits $5,000 and the gold-to-silver ratio returns to its ancient baseline of 15-to-1, what happens? 5,000 divided by 15. The math gives you $333 per ounce of silver. Suddenly, that crazy $300 prediction isn't based on hype. It's based on a return to a mathematical reality that has existed for 5,000 years of human history. But you might be asking, if the math is so obvious, why hasn't it happened yet? The answer lies in the way the big banks and institutions play the game. They've treated silver like a boring industrial metal, something used for solar panels and electronics. They've ignored its soul as poor man's gold. But the tide is turning. When the S&P 500 begins to wobble and the bond market starts to smoke, big money doesn't look for industrial utility, it looks for a store of value. And because the silver market is tiny, literally a drop in the ocean compared to the trillions in the stock market, it doesn't take much smart money to send the price vertical. When that 80-to-1 rubber band finally snaps, it won't be a slow move. It will be what Oliver calls violent congestion, breaking into a massive upward surge. It's the feeling of a coiled spring being released. The aha moment here isn't just about the price of silver going up. It's about realizing that silver is currently the most undervalued asset on the planet relative to its yellow brother, gold. You are looking at a mathematical spring that has been compressed for decades.
But math is just a foundation. To truly understand how this explosion happens, we have to look at the ghosts of our financial past. Because what happened in 1970 and 2011 wasn't an accident, it was a preview. And the setup we are seeing today, it's even more explosive than both of those combined. In the next part, we're going to look at the momentum break and why the very people who tell you silver is dead are the ones most terrified of what's coming next. But math is just the foundation, the dry wood waiting for a spark. The real question is, what actually pulls the trigger? To find that catalyst, we have to look at the ghosts of our financial past, because history doesn't repeat itself, but in the silver market, it certainly rhymes. Let's go back to the 1970s. This was the era of great stagflation. The US had just severed the final link between the dollar and gold in 1971. Inflation was ripping through the economy, and the public suddenly realized that their paper money was losing its soul. What happened next was a short squeeze of biblical proportions. Silver didn't just go up, it went vertical. It climbed from under $2 to nearly $50 in less than a decade. That is a 25x return. Why? Because when faith in the system dies, everyone tries to cram through the same tiny exit door at once. Then look at 2011. Following the 2008 financial crisis, the Fed launched the greatest money printing experiment in history, quantitative easing. As the dollar's purchasing power began to smoke, silver surged again, hitting $49 an ounce. In both cases, the trigger was the same, a loss of confidence in the central bank's ability to manage the currency. Now, Michael Oliver points to a phenomenon he calls violent congestion. It's a technical term, but think of it like a pressure cooker with the valves stuck shut. For years, silver has been trading in a sideways range. To the average investor, it looks boring, it looks dead. But under the surface, the momentum indicators are coiled like a professional athlete at the starting block. This congestion is the market trying to find a price in a world where supply is shrinking and industrial demand, from EVs to AI data centers, is skyrocketing. Oliver's analysis shows that when the momentum breaks out of this sideways prison, the move isn't gradual, it's violent. It's an explosive release of all that stored energy. Why is it so much more violent for silver than for gold? It's a matter of market physics. The total amount of investable silver in the world is microscopic compared to the trillions floating in the S&P 500 or the bond market. Imagine you have a giant swimming pool representing the stock market and a small glass of water representing the silver market. If you take a bucket of water out of the pool and try to pour it into the glass doesn't just fill up, it overflows everywhere. That overflow is the price surge. When just 1% of the institutional money fleeing the 50% stock market crash, the one Oliver is predicting, tries to enter the silver market, there simply isn't enough physical metal to go around. The price is forced to gap up to find sellers. This is how you get silver at $50, then $100, then $300. It's not about greed, it's about a total lack of liquidity in the face of overwhelming demand. In the 1970s and 2011, the ghost was inflation, but today the ghost is something far more dangerous. We aren't just facing inflation, we are facing fiscal dominance. A situation where the government is so deep in debt that the Fed is no longer independent. They're forced to print money just to pay the interest on the debt. This is the atomic atomic trigger, that makes the current setup more explosive than 1970 or 2011. In those years, the Fed could still raise interest rates to kill inflation. Today, if they raise rates too high, they bankrupt the U.S. Treasury. They're trapped. And when the market realizes the Fed is trapped, the violent congestion will break. The transition from paper wealth to hard assets is no longer just a theory for gold bugs. It is becoming a survival strategy for the 1%. But there is one more layer to this story, because while silver is the favorite, it is being fueled by a structural shift in the global power dynamic, something called the negative real yield trap. In the next part, we're going to look at the physics of the escape. We'll see why the very mechanism meant to save the banking system is the exact thing that will send hard assets into the stratosphere. We're moving from the history to the engine of this move. And trust me, if you think the 1970s move was big, you haven't seen anything yet. Now we have the math and we have the history. But to understand why this time could be far more explosive, we need to talk about the engine driving the entire collapse. It's a term economists call fiscal dominance, and it is the ultimate escape script for hard assets like silver. Think of the U.S. economy as a giant ship. In a normal world, the Federal Reserve is the captain, using interest rates to steer away from the rocks of inflation. But today, the ship is carrying so much debt, over $34 trillion, that the captain has lost control of the wheel. The debt is now steering the ship. This is fiscal dominance. It happens when the government's interest payments become so massive that the central bank is forced to keep rates low and print money just to prevent the Treasury from going bankrupt.
They aren't printing to help the economy anymore. They are printing to survive. And this leads us to the most important concept for your wealth: negative real yields. In a healthy market, you put money in a bond and you get a return that beats inflation. But in a world of fiscal dominance, the Fed must keep interest rates lower than the actual rate of inflation. If inflation is at 7% and your bank account or bond only pays you 4%, you are losing 3% of your purchasing power every single year. Your money isn't working for you. It's being harvested to pay off the government's debt. This is the negative real yield trap. And when the masses realize that holding paper currency is a guaranteed slow-motion robbery, they don't just look for an investment, they look for an exit. Silver, for decades, was treated as a boring industrial metal, something used in solar panels, EVs, and 5G towers. But in the age of fiscal dominance, silver undergoes a metamorphosis. It transforms from an industrial commodity back into its ancient form, the ultimate insurance policy. Why silver instead of just gold? Because of the entry price and supply squeeze. Gold is the castle, but silver is the gate. As I mentioned before, the silver market is so thin that when the bond vigilantes start fleeing the $34 trillion debt bubble, they will hit the silver market like a tidal wave hitting a teacup. But I have to be honest with you, this path isn't a straight line up. There is a major counter-argument we have to address: liquidity risk. In the early stages of a 50% stock market crash, like the one Michael Oliver is warning about, everything often goes down at first. Why? Because traders facing margin calls on their crashing Nvidia or Apple stocks are forced to sell their winners, their gold and silver, just to raise cash. We saw this in 2008. Silver dipped before it went on its 400% run. So if you see a sudden drop in silver during a market panic, don't be fooled. That isn't the end. That is the violent congestion reaching its breaking point. It's the final chance for the smart money to grab physical metal before the Fed is forced to launch the biggest money printing operation in human history to save the bond market. Once the printer goes into overdrive to combat the crash, the real yields will dive deep into the negative. At that moment, the industrial value of silver becomes irrelevant. Its value as honest money takes over. Michael Oliver's $300 target isn't based on silver becoming more useful in electronics. It's about the total breakdown of the paper to hard asset ratio. It's about the ship hitting the rocks and the passengers finally realizing that there are only enough lifeboats, physical gold and silver, for about 1% of the people on board. You see, we are moving past the era of investing for 10% gains. We are entering the era of positioning for systemic survival. The math says silver is undervalued. History says it's coiled. But the fiscal dominance engine says the breakout is inevitable. The only question left is, how do you distinguish between the price on a screen and the actual value of what you hold in your hand? In the final part of this analysis, we're going to tie all of this together. We'll look at the end game kick barn and the one question you need to ask yourself tonight to be ready for the secular rotation that is already beginning to turn. So, is $300 silver a guarantee? No. In the world of finance, there are no guarantees, only probabilities. But as we've decoded today, that number isn't just a headline designed to scare you. It is the mathematical conclusion of a very specific macro kick barn, a world where the S&P 500 sheds half its value, where the bond market loses its status as a safe haven, and where the gold to silver ratio finally snaps back to its historical reality. The secular rotation Michael Oliver warns about isn't just an investment tip, it's a tectonic shift in how wealth is defined. For decades, we've been taught that wealth is a number on a digital screen, backed by the promises of central banks. But as fiscal dominance takes hold and real yields dive deep into the negative, those promises are becoming increasingly expensive to keep. Silver at $300 is simply what happens when the lifeboats become more valuable than the sinking ship. Whether we reach that exact price this summer or 2 years from now is almost secondary to the bigger mission, protecting your purchasing power before the violent congestion breaks wide open. Now, the choice is yours. You've seen the math, you've seen the history, and you've seen the engine driving this move. If tomorrow morning the S&P 500 really does begin that 50% slide, do you have your parachute ready? Do you trust the mathematics of a 5,000-year-old asset, or do you still have full faith in the strength of a paper dollar? I want to hear from you. Are you betting on the 15-to-1 ratio, or do you think the system will find a way to stay afloat? Comment mathematics or cash below, and let's get the discussion started. Don't wait for the breakout to start paying attention. By then, the exit door might already be jammed. I'll see you in the next analysis.